Still says here it's starting. Do you see anything on YouTube?
No.
I don't like this.
It says live, but I don't see any.
There you are.
Oh yeah. Hello, everyone. Oh, interesting. The video is quite a bit behind.
Still says here it's starting. Do you see anything on YouTube?
Yeah, it showed me for a while on YouTube, and now you just lost me. It's switching back and forth.
Don't pay attention. There's a delay. That's pretty normal.
Yeah, but it's just disappearing.
It says live, but I don't see it.
There you are.
Yeah, I'm clicking on and off.
Hello, everyone.
All right. I think we are live. Hello, everyone.
Yeah, it showed me for a while on YouTube, and now you just lost it. Switching back and forth.
Don't pay attention. There's a delay. That's pretty normal.
Yeah, but it's just disappeared.
Yeah, I'm clicking on and off.
All right, I think we are live. Hello, everyone.
All right, and sorry, there was a little bit of confusion at the beginning. There seems to be a lag between the time that I speak and the time that it appears. So I'm just getting myself synchronized with that. So from now on, I'm going to go straight forward. So hello, everyone. It is lovely to see so many people from so many countries participating today. I am Antonis Polemitis. I will be one of your two instructors today on DFIN 511, Introduction to Digital Currencies. That is the first class of the Masters in Digital Currencies at the University of Nicosia. We are going to be running 12 sessions of this course. This is the first session of this course. And then we'll be running approximately weekly the live sessions through the whole fall. I will do half the sessions. The other half will be done by Andreas Antonopoulos, my co-instructor. And I wanted, before I get into any of the material, to talk a little bit about the structure of the course, the history of the course, why we're doing the course, and generally how it's going to operate. This course was first ran in early 2014. It was the first accredited university course ever run on the topic of cryptocurrencies. The University of Nicosia, which is where this program started, is a large regional university based in Cyprus, one of the larger English language universities of Southern Europe. And we decided about 2.5 years ago that cryptocurrency was a very significant innovation in both computer science and in financial services. And then as the more we looked at it, a broader and broader array of topics. Given this, we decided we were going to make a strong university-wide effort to be leaders in this field. We were the first university to accept Bitcoin for tuition, to teach a course in cryptocurrency, and then to teach a full degree program in cryptocurrency. We were the first university to place and hash a academic certificate onto the Bitcoin blockchain. And we were the first university to graduate students with a degree in this topic. So this summer, we had the first 15 graduates of the Masters in Digital Currency. That was the first graduating class of the full degree program. So I think it is fair to say and accurate to say that we are very much committed to this area. We think we're a global leader in this area, and it is something we plan to continue focusing on and investing in over the next several years. This course specifically has two functions. It is, first of all, a free open MOOC that is a contribution to the broader community in both cryptocurrency or just people who are interested in cryptocurrency. And through this course, several thousand students have taken it since its inception. Your class is the largest class that it has ever had, and it seems to have the most diverse group of students we've ever had, and we see that in the chat over to the side, that there are students at daytime, nighttime from around the world. Hopefully from here in Cyprus, we are fairly balanced between the Eastern and Western hemisphere, so it's 7 o'clock here. People late in the evening, some people in the afternoon, some people early in the morning. If you complete this course, you have two types of outcomes that are available to you. Best one is a certificate of completion. You will earn that by participating in 75% of the quizzes and earning over 60% on the final examination. You can also have a certificate of participation if you complete 75% of the quizzes and don't earn a 60% of the final examination, but hopefully most of you that go all the way through and complete the final examination will earn the full marks for the program and get a certificate of completion. This course has a second function as well, though, which is that it's the first course in the Masters of Digital Currency. So this is a master's degree focused on the technical and non-technical implications of digital currency on the legal, financial system. It focuses, and there is a track that is focused on more technical programming topics, and there's a track that is focused more on business and legal topics. So every student who went on to enroll in the Masters did this course first. And for those of you who are interested in enrolling in the Masters, this course will count as credit for your first 3 credit hours in the Masters program. And then from then on out, you'll continue on the regular Masters program, which is also delivered online in English. It takes about, depending on how often you take your classes, 1.5 to 2 years to complete. We think that's a fabulous academic program. It's the first of its kind. It's still the only one of its kind in the world, though I think some other universities are close to launching ones of their own. The graduates of this program have all more or less become employed in the broader cryptocurrency space or in the broader financial services space. So we have graduates of these programs working in cryptocurrency companies, building their own cryptocurrency business, or working as professors or central bankers and so on. So for those of you who are looking for a more comprehensive offering, something to build your CV, something that would move you into this industry, something that would differentiate you in your field or industry, I think it's a fabulous program. There will be folks from that program available during the course of the MOOC to chat with you about if it's the right choice for you, if it's a good fit, and if it's something you'd like to pursue. So if you are thinking that it might be a possibility, and you don't know yet, I would definitely encourage you to chat with some of our advising staff because they are quite knowledgeable on this topic. And also feel free to chat with George Babayuriu. George Babayuriu has been a co-instructor of mine on certain other courses here. He has been involved with the program since the beginning. He's the guy that makes the ships run on time and the trains also run on time and probably some other vehicles also run on time. If you have any questions whatsoever, he is certainly able to answer them. And I hope in January, when the next cohort begins for the master's program, that we will see many of you in that program. A little bit about myself personally, so that you have some background. I was a partner in a consulting firm focused on the private equity industry and the financial services industry in New York. Then I was a partner in a private equity firm in New York focused on business and financial services. So I spent most of my career in financial services. I have somewhat of a background in computer programming and have always remained active on the tech side. I have helped build 3 or 4 technology platforms for different businesses, including what was at the time one of the leading video publishing platforms in the world. So I think I have a balance between financial services and technology, probably a little bit more on the financial services side than on the technology side. And so this is something that made Bitcoin very interesting to me when I first encountered it several years ago. I could immediately see how it was going to be a very relevant technology, but I could also see how it wouldn't simply just take over the financial services world by storm, that there were very detailed and complicated topics that needed to be addressed. And that was some of the thinking that went through into developing this program. I also run a large set of the university's administrative operations day to day. So I'm mostly based in Cyprus, partially in New York, and I'm involved in some of the administrative, non-academic aspects of the university. For me personally, I want to encourage you that if there's something I can help you with during the course of this course, feel free to reach out to me. I will probably be slightly non-conventional, and I will tell you the most likely order to get a quick response will be to find me on Twitter, where you can reach me at Polemitis, Polemitis. The second fastest way to get a response from me is probably LinkedIn. Then I would say the third fastest way would be my email. And probably the slowest way, and I'll probably get in trouble for saying this from our distance learning folks, is actually through the messaging system in the platform. And I'll probably get a demerit on university policy here, but I think that's accurate. But feel free to reach out to me in any of those ways. I'm quite active on all of those systems, and I am happy to address any questions, concerns, issues, ideas, thoughts you might have during the duration of this course. So, with that preamble, I wanted to jump in to answer some of the questions that you submitted. Well, you're not going to be able to answer all of them because this was a huge set of questions that were submitted. So we tried to pick some that had some commonalities. We're going to try and address some of them, and we'll aim for some general themes as well. So the first question is the following. I see the advantages of cryptocurrency, especially decentralization of currency and expediency of the transaction. What I don't understand is that private, i.e. SWIFT, and government, i.e. Federal Reserve Board in the US, would have to relinquish their control over fiscal transactions. Raw Bitcoin transactions would not require these central agencies. Nobody likes to use power or to be put out of business. Do you see adoption of many cryptocurrencies being led by many central agencies using their own blockchains from chain.com? This is a complicated question, a big question, a question that actually takes into account many different topics simultaneously. And while there's no clear 100% right answer, I'll give you my best shot at it. It is certainly the case. I think the first way to think about Bitcoin in the context of this question is like a private form of cash. So even public entities issue cash. And while some of the more advanced electronic nations, primarily the Nordic ones, are making significant progress in phasing out cash, it is still by far the number one system for transaction volume in the world by a wide margin. And by transaction volume, I mean the number of transactions that are conducted in cash far exceeds the number of transactions that are conducted via Fedwire or chips or Target 2 or what have you, the various common systems, let alone SWIFT and so on. Yet governments seem, while they sometimes have some level of discomfort around cash because of tax reasons or money laundering reasons, it is a base model of transactions, and realistically around the world isn't going away anytime soon. So at one level, if I pay a vendor for something with Bitcoin where I would have previously paid with cash, maybe it's slightly concerning to a government, but it's not going to put Fedwire out of business. That's not what Fedwire is for, right? These systems are used between big institutions as a general rule. They're used for large transactions as a general rule, and they don't have retail customers as a general rule. They're typically known as at the backbone of the financial system are RTGSs, real-time gross settlement systems. And so they have finality of transaction, they are real-time, and they're gross, which means they're not aggregated against each other. So will there be governments that try to control digital currency transactions? Absolutely. What will characterize those governments? Realistically, there are governments who try and control currency transactions today. So let me describe a little bit what I mean. Let's say you're running a closed economy with a fixed exchange policy and currency controls. If you have currency controls, you are controlling how people move their money, regardless of what systems may exist to move it, whether it's a SWIFT system or people just putting cash in a suitcase and taking it out of the country. You have restrictions on these things. If you have restrictions on these types of transactions already, then certainly you're not going to be favorable to someone using Bitcoin to evade those restrictions. And so these are, the more closed a system is in terms of traditional currency movements, the more closed it's likely to aim to be in terms of cryptocurrency movement. Systems that are more open, like the United States, has passed a variety of regulations regulating the exchanges that have generally anti-money laundering characteristics. But individual Bitcoin transactions between buyers and sellers or individual money transfers are effectively not regulated any differently than cash is. Now, they still have tax implications. If I sell something and I would have had to collect sales tax if I sold it with US dollars, I should be collecting sales tax if I sold it with Bitcoin. That doesn't change, but there's no particular restriction on having that transaction. Could I imagine a world where even an open economy gets highly concerned about this topic? Possibly, but for that to happen, Bitcoin would have to become substantially more systemic than it is today. So the whole Bitcoin market capitalization over the last few years has fluctuated, but it has generally stayed below 10 billion US dollars. In a world where major currencies have money supplies in the trillions, it is not a systemic risk to any large economy. The Federal Reserve has said this several times. And so for now, they're in a wait and see mode to see how it develops. I suspect before Bitcoin got to the point that it could risk monetary stability of an economy and then they'd want to regulate it, you will see governments launch their own cryptocurrencies. And when I say they launch their own cryptocurrencies, they're not going to make a United States coin. What they would make is a dollar that is transactable in digital form, in a manner possibly similar to how cryptocurrency works today. And that gives you a version of digital cash, which is what these cryptocurrencies do, and keeps it tied to the money supply of the country that issued it. Now, there's embedded another question here. It was not directly the question that was asked. Don't you need fewer intermediaries in a world like this? And will fees go down from intermediation of financial transactions? Broadly and over a long period of time, I think the answer to that is yes. So I am less worried about the Federal Reserve being concerned that they're being disintermediated for transactions. I'd be more worried that if I was a money central bank and I made a lot of money processing transactions domestically and internationally, that the availability of a low-cost open option will act as a pressure or brake on my fees. And so I would expect the folks that would be most negative about cryptocurrency are actually the commercial bankers. And I think that's how it's played out, to be honest. Now, they've gotten a little bit more positive than they used to be. At first, 3 or 4 years ago, they said, oh, this is just going to go away and vanish, and it's a tulip bulb. We've now gotten to the phase where they say, well, it's actually not a bad idea, but we're more interested in the technology of blockchain and the currency of Bitcoin. So we're in that phase now, which is a phase that we saw with the internet as well, that once people saw how open networking could work, they said, well, this is great, but I'm going to build my private network. I'll have a wide area network, and it will be private, and I'll get a lot of the benefits of the internet without being out there in the more scary, less controlled internet. I think we're seeing some of that now in the marketplace. I think it will continue for a while. I think you'll see a lot of blockchain trials being tested. And while that's happening, while everyone says Bitcoin is not so relevant, it's the blockchain technology that's relevant, you see every month transaction volume tends to go up, mining hash power tends to go up, and so there's a slow and steady progression of the open permissionless technology. So I do think some private actors will be hurt a little bit over time, but it's going to be a long period of time. I mean, the voice over IP theoretically could have disrupted the telephone companies. In fact, what happened is it merged in a way with the telephone companies. So Skype now accounts for over 50% of global telephony, and rates for phone calls have gone down tremendously, but usage of telephony has gone up tremendously, and telecoms now use voice over IP in their own networks. So telecoms didn't go away. Prices for telephony went down quite a lot. Usage went up quite a lot. And on the whole, the person who benefited the most was the consumer, because now you can consume domestic telephony practically free, and international telephony has dropped dramatically. And we can be sitting here on a free service where I'm video conferencing to dozens of people around the world, something that would have been a multi-hundreds of thousands of dollars of exercise 20, 30 years ago. I suspect that's a useful analogy for thinking about cryptocurrency and the existing financial system. Banks aren't going to go away. Transactions, the traditional system, aren't going to go away. But some of these principles will exist both in the non-traditional system and the traditional system. Transaction fees will probably go down, and transaction volume will probably go up. And you might say, well, why would transaction volume go up? I'm only thinking of, if I was going to buy a coffee or buy lunch yesterday, just because cryptocurrency is around, it's not like I'm going to buy 2 coffees and 2 lunches. And that's absolutely right. That's not why transaction volumes are going to go up. Transaction volumes are going to go up because this will enable machine-to-machine transactions. So I might lead to another way to think about it, which is email didn't make the post office go away, though it did limit its growth somewhat, but it created a whole different class of transactions, which is email. And so here you might see cryptocurrency driving a class of transactions like browser micropayments to publishers, or Bitcoin-based spam filters, and so on. So I think transactions get cheaper, and generally when they get cheaper, there's more of them. So it's interesting because it's the shortest question, but you could actually fill probably half a course on the possible answer to that question. And so these are my general thoughts on this topic. The next point, which was addressed in a couple of different questions, and I'm going to try and merge them together, which is, if Bitcoin was a commodity-backed currency, then what would be the commodity? The slide says the usage of the applications that the Bitcoin network enables, but I don't get what that means. Does it mean what you can buy with Bitcoin? That would be like saying that the Frappuccinos are the commodity buying the US dollar, which wouldn't make sense. That's correct. That wouldn't make any sense at all. The way to maybe think about this is, and I've heard a few analogies, I'll try a couple for you guys, is imagine that you had a stock exchange, and in order to trade stocks, you had to buy a seat on the exchange. That seat has value because it allows you to trade stocks. It doesn't have value directly because of the stock itself. So it's illogical to say a seat on the exchange is valuable because the price of General Electric is $132, but the seat on the stock exchange is valuable because it allows you to engage in trading activities on the stock exchange. This is something like the concept here, which is, if I need Bitcoin to be a vehicle to transfer value among different applications online around the world, then someone has to put value into that vehicle in order to get it across. So if I want to move $1 million from Cyprus to the Philippines, I need to buy, at least for a short period of time, $1 million of Bitcoin, send the Bitcoin to the Philippines, and then take out $1 million of Bitcoin. And that's in the current environment where I'm still assuming that you're using national currencies on both ends of the transaction. Well, the act of me buying that Bitcoin, even if I'm selling it later, creates a market price for it. So I'm buying the vehicle to transfer the value, and the commodity that is backed, a commodity that is creating that value is its ability to transfer value. So I think that's the way to think about it. Now, it's a little counterintuitive. It's not a commodity the way gold is, because gold is tangible. You can see what the commodity is, but it's a commodity in the way intellectual property might be, or a license to operate might be. Maybe another way to think about it is, if you license spectrum for the government to transmit in that spectrum, you will pay a price for that spectrum because you then know you can deliver services through that spectrum and people will pay you money for it. So if you purchase Bitcoin because you can use Bitcoin to deliver services that use Bitcoin and people pay money for those services, it creates some value for that vehicle. So it's abstract, it's a little complicated, it's a little bootstrapped, to be honest, but I think there's some validity to thinking about it that way. Was the US ever, or is it now tied to gross national product? Would gross national product be considered a commodity of sorts? The US dollar has not been tied to gross national product. I'm not sure how that would work exactly. The value of a currency in a convertible system is driven by supply and demand for that currency. And so the foreign exchange markets are the biggest, most liquid markets in the world for any financial instrument. There are trillions and trillions of dollars traded every single day in foreign currency. And so the sum total of the purchases and the sales of US dollars and euros and yen are what create the relative exchange rates and the relative value of the currencies. So it's not as if they're set by someone in a freely convertible currency. In non-freely convertible currencies, yes, they are set, but since that's like trying to hold back a dam, then you have to make controls so people don't move them around at rates that you don't want them to move them around at. Where I've seen people discuss GNP or GDP-based instruments is more for governmental debt. And so people have sometimes kicked around the idea that it creates better alignment between the government and its creditors if the government, instead of issuing debt with an interest rate, issues debt that is tied to GDP or GNP, as the case may be, but generally you see it as GDP. And so that would be an instrument whose value would rise if GDP went up and value would fall if GDP went down. So you and your creditors might have more aligned incentives that you have now. It's almost like a form of equity, though it's hard to sell equity in a country, so it's a way of selling pseudo-equity in a country. Now, the GDP of a country, the political stability of a country, the military strength of a country, all in effect provide value to a currency. They're not directly backing it in the way that commodity money would back the value of commodity money. So when the dollar was tied to a certain amount of gold, that was an explicit backing. When people see value in the US dollar because they think it has economic strength and political stability and military strength, and so you don't think the American economy will collapse, so you think if you held US dollars, they hold their value better than if you held Venezuelan bolivars. That is an indirect form of backing, but it's not an explicit form of backing, and it's a backing that is judged every second in the currency markets. I see an interesting comment by Simon about one of the prior points, which says you could use the same argument to say any currency or payment system, e.g. Western Union, is commodity backed because it's useful for making payments. In a way, that's true, right? Western Union has a market value. If you went to the shareholders of Western Union and said, please give me all your equity, they would say, well, sure, we'd love to, but please sign over a check for several $1 billion, because otherwise, why would we give it to you? And that equity instrument is, in effect, backed, or the value is determined by the rents and charges it can generate for the use of its system. And so it's not a crazy analogy to think about it that way. And I can say that in that case, the legal instrument that represents Western Union's value is its equity shares plus actually the value of its debt. It's its full enterprise value. And since Bitcoin doesn't have that type of structure, there's no equity you can buy in the enterprise called Bitcoin, that value ends up somehow, interestingly enough, getting reflected in the tokens themselves that move Bitcoin. A small technical-ish question, this one I can answer easily. Slide 38 says on the topic of closed communities, private money must be exchanged for conventional currency and then used within the community. Should that not be the other way around? Conventional currency must be exchanged for private money and then used in the community. Or rephrased, private money must be exchanged for conventional money, currency, and then can be used outside the community. I think the answer to all these is yes. I think we're all meaning the same thing. For the private money to have broader external value, at some point you're exchanging it back and forth with conventional money. And depending on which direction that transaction is going, one of them is going to be on the left side, one of them is going to be on the right side. But you exchange going in, you exchange going out, and so you are switching them in both directions, and the conventional money gives value to the private money that you use in the community, and then you can extract private money from the community into conventional money again by exchange, and that's another way it maintains value inside the community. So I think it's a good point. I think it's accurate. I think we're saying the same thing, and maybe we can look at this and fine-tune the presentation a little bit. Next question. Is Gresham's law applicable to competing digital currencies? Gresham's law that bad money drives out good money. Do you expect this to apply to competing digital currencies? Would we then expect bad digital currencies to drive out good digital currencies? What would that even mean? The short answer is no, I don't think so, barring some technical development that hasn't happened yet. Gresham's law works in commodity money the following way. If we have a silver-based currency and I shave off a little bit of the silver on my coin because I think, I can keep a little silver and no one's going to notice the difference, and I'm going to pass my coin on with less silver, then that type of environment is a system where everyone starts cheating a little bit because everyone's trying to pass along the bad money, the money worth less, and hold on to the good money, the money worth more, the money that has not been shaven off. And so everyone eventually has incentive just to be putting bad money in the system, and it accelerates into a vicious spiral. Within any particular cryptocurrency, that doesn't really apply. It's quite difficult to imagine how you can counterfeit a Bitcoin. In fact, one of its greatest innovations is understanding how creating a non-counterfeitable digital asset. So if I could give you a Bitcoin that was really 90% of a Bitcoin and you couldn't tell the difference, then Gresham's law would apply. Since I can't do that, it certainly doesn't apply within Bitcoin. Now, does it apply across all competing digital currencies? No, I'll be honest, I don't think so. In the same way that Gresham's law doesn't mean that if we're using gold currency and someone says, hey, I want to trade in cigarettes, the cigarettes aren't going to drive the gold out of the market. The cigarettes are going to be viewed as a different private currency, an inferior private currency, and just used or not used, ignored or not ignored, but they're not going to drive out the gold. In the commodity currency, it's inferior versions of the same thing that drive out the superior versions of the same thing. Someone asks, could a physical coin be produced for each transaction, safeguarded by the following characteristics that would add confidence in the system? Embedded with the transaction number, perhaps in gold, and scan code bar for the transaction number on one side, and multi-changing holographic images on verso, registered by image code tied to transaction number with independent crypto bank. While not necessary, it could add the credibility of physicality. My short answer is I don't think that's going to be something that happens in any meaningful sense. People have made physical coins already of Bitcoin where they are doing something like having the private key underneath a hologram or a sticker or what have you. And so it exists, but for me, it more or less misses the point of Bitcoin. We have a long history of physical currencies, both sovereign and commodity and private. And so I'm not sure that one more physical one actually adds anything to the picture, to be completely honest. What I think is one of the big leaps forward with Bitcoin is that it gives us an electronic currency that is open, the way cash is open. Not an electronic currency that has a central gatekeeper, but an electronic currency that is open the way cash is open. And that's allows, given that we're now in a world that operates heavily electronically, that opens up a whole bunch of usage cases that traditional cash can't address well. So taking it out of that world and bringing it back into the physical world, well, there's no reason you can't do it, and people have done it. I don't know that why that would be hugely popular. I think the type of person who's going to invest a lot of money just to hold money in Bitcoin is probably going to get comfortable with Bitcoin in its electronic form to begin with. And the type of person who's using Bitcoin to have transactions is certainly not going to be doing them physically, right? It's hard to imagine too many transactions where with Bitcoin that they'll be best done with a physical coin as opposed to through an electronic wallet. Because if you just hand one of these coins to someone else, they need to verify it, and you're back into the electronic world. So I don't think that's going to be a big issue. Now, there's a series of questions on central banks. And there's a whole course embedded in here. So I'm going to try and combine them and try and answer them in aggregate. The general questions are, why are there booms and busts? Would things be better with without a central bank? Would some predictable deflation would be good, like the 19th century US? Could interest rates be set by the market instead of a central bank? Are small recessions good for economies, but using interest rates to put them out by stimulating may eventually lead to bigger economic disasters? Is there truth to this? How or how not? How or how not? I'm going to give you the conventional macroeconomic answer to this question. And I know there'll be some people for sure that will disagree with me. And that's fine, because there's another school of thought on this. But certainly it is the case that in developed countries, a conventional view has developed that it is better to have a central bank with some monetary flexibility than one that's set in stone in its pathway. And a further theory has developed that deflation is very, very dangerous, just as dangerous as medium to high levels of inflation. And the reason for these two theories is the following. In the first case, people believe that central banks can dampen out swings in the economy and lead to smoother economic growth and outcomes. And the experience of credible, sophisticated central banks is reasonable in this regard. It actually is. Now, there's experience with many countries that have poorly run central banks and aren't credible and do a bad job of this. But then, is that relevant to the question? I'm not sure. Well-run economies with well-run central banks haven't had massive inflationary or deflationary crises in their currencies for several decades now. Now the question is, why do economists not like deflation? Their concern with deflation is that it actually leads to real reduction in output in the economy. So the real wealth of a country is not what your dollar says it is, right? The real wealth of a country is how many goods and services the country produces. If you believe that, then unemployment is a very, very bad thing, because unemployment means quite literally some percentage of your population is sitting around doing nothing. And if they're doing nothing, they're not producing goods and services, so they're not increasing the aggregate wealth of your nation. Deflation has a set of circumstances that could lead to an escalating set of unemployment, which goes something as follows. Let's say you knew for sure that the price of something would drop tomorrow, because that's what deflation means. Prices are always going down. You might think to yourself, well, I'm not going to buy this today, since if I wait tomorrow, I'll get it cheaper. By the way, if it's economy-wide deflation, everyone will think that way, and everyone will think that way about every single product. Some things you can't get away with not buying daily. I mean, you need food, you need water, maybe you need gas for your car, but your major purchases, you can always wait an extra day. You can buy your house tomorrow, you can buy your car tomorrow, you can buy your washing machine tomorrow, you can sign up for university tomorrow. The price is going to be a little bit lower. The problem is, if everyone does that, then nobody buys anything. When a company isn't selling anything, it's going to do one of two things. It might say, I am going to lower my price further because I want to stimulate someone into buying. If it lowers its price further, it increases the deflation and makes people think, wow, prices really are dropping. Let me wait some more and I'll buy even further down. Eventually, if nobody's buying anything, and I realize this is a stylized example, but it's a stylized example saying what the problems are with deflation. And then a company says, well, wow, nobody's buying anything. I've dropped prices, no one's buying anything. I don't need my staff because I can't be producing widgets. Nobody's buying widgets. So it lays people off. Now there are people that not only believe prices are going down, don't have a job. Without having a job, they're less likely to buy something. When they're less likely to buy something, demand falls further, price falls further. Everyone says, oh, look, the prices are dropping. And you can get into this really vicious cycle where you cycle your way into very high unemployment and real dramatic losses in the economy. The Great Depression played out like this. We are seeing this play out right now in Greece. Greece is, in effect, has no control over its monetary policy and has been stuck in a deflationary spiral. It has not accomplished what people had hoped it would accomplish. So this is not to say that Greece is well managed economically. It hasn't been. This is not to say that Greece didn't spend beyond its means. It did. But it's also to say that every single thing that is happening in Greece has exactly 0% chance of working, and Greece is stuck in a recession that is actually equivalent to the Great Depression in the United States. Over a quarter of the Greek population is unemployed, which means 1 out of every 4 people is not contributing to the Greek economy. That every day is a loss of potential wealth for the Greek economy and the Greek nation, because 1/4 of the economy is not operating. By the way, it's worse than that, because when people stay out of the job market for years, they lose skills, they become less employable, they lose motivation, they lose confidence. If they're capable, they might emigrate to other countries, as has happened with a lot of Greeks. And so even later, when the economy might theoretically pick up, the human capital of the country has been permanently diminished. As the economy shrinks, by the way, the debt overhang, which is what caused the problem in the first place, just gets higher, right? Because the debt sustainability is looked at as a ratio of debt to GDP. So if you get into a deflationary spiral where prices are falling, GDP is falling, your debt ratio is getting higher relative to your economy, more and more people are unemployed, nobody wants to spend anything, well, you end up looking like a US in the Great Depression or a modern day Greece. It's not generally thought of as a good outcome by economists. Economists tend to think a low predictable rate of inflation acts as a better stimulant for the economy. Predictable, because if it's predictable, you can plan for it. I like these charts that say, oh, look, the value of the dollar has fallen 90% in the last 100 years. Sure, but like, who sits and holds dollars in any meaningful numbers in a non-return generating investment for 100 years? Nobody. Everyone knows it's going to be depreciating 1 or 2% a year. So you wouldn't imagine that holding cash for 100 years is a good investment. I mean, certainly no one sophisticated on the finance side has ever suggested that's a good strategy. And so with a little bit of inflation, there's a little bit of incentive, to spend money earlier rather than later. If I think houses are going to be a little bit more expensive next year, well, maybe I'll push to buy one now. And that tends to lead to more demand, leads to more production, leads to more jobs, tends to be, I think, a healthier economic dynamic. So another way to think about it, it's a way of prioritizing labor and equity holders over debt and creditors. And that's not a perfectly right or wrong answer. It's a little bit of a zero sum between the two of them. But I think most research believes that and it all depends who you can, it's tricky because all depends who you can put in your sample set. You put a Venezuelan and Zimbabwe in your sample set, and it's going to look very different than if you say your sample set is the US and Switzerland, right? But most people believe that this type of model is more effective. I think we try and stay away from this in the program for the following reason. It's not really Bitcoin's job or any cryptocurrency's job to address the last several hundred years of theory about central banking and monetary policy, fiscal policy. Those are big, complicated issues. They didn't start with Bitcoin. They're not going to end with Bitcoin. And I'm not sure they're actually relevant, to be honest. Unless those issues are only relevant for the unit of account of a country. So if Bitcoin is deflationary or if Bitcoin is inflationary, makes no difference to US monetary policy. What matters is what's the unit of account, and if it's deflationary or inflationary, and that's the US dollar. For a private currency, everything that I was about to say, I would reverse. A probably necessary condition for a private currency to get itself off the ground is that it's at least slightly deflationary, because then people might be tempted into it to say, oh, it's deflationary, it means its price is going to go up. I don't mind holding some Bitcoin, maybe its price will go up. If everyone was sure its price would go down, no one's going to hold Bitcoin. If no one holds Bitcoin, it doesn't actually kick off a virtuous cycle of more people holding it and using it, what have you. With a national currency, it's different. You kind of have to hold it. You need it to transact. So you can get away with having a little inflationary bias in the currency in order to serve other societal objectives like unemployment. In a private currency that nobody has to hold, I think it's difficult to be inflationary. I think you need to be a little bit deflationary, in the same way that people are attracted to any other deflationary financial asset. Like if you bought shares of Apple stock 20 years ago, it's been tremendously deflationary. What does that mean? The value of Apple stock in US dollars has gone up a lot. Well, you don't think of this as a bad thing, you think of it as a very wonderful thing. You bought Apple stock and you are now relatively richer than people who didn't buy Apple stock. So I think one danger here is looking at the fact that it might be very sensible for a private currency to have a deflationary bias the way Bitcoin does. It might even be necessary for a private currency to take off for it to have a deflationary bias. And it might simultaneously be sensible for a sovereign currency to have a small deflationary bias. And on both these things, you can asterisk them 15 different ways, because there are whole academic departments at different universities that have different opinions on all these things. And you have the famous question of the three-handed economist. On the one hand, this, on the other hand, is this, and on the third hand, it's this. So I don't think we will solve macro tonight or at any point in this course. And I would just encourage you to think about if it's really relevant to anything that has to do with cryptocurrency. I am at exactly 1 hour when I started. So what I'm going to suggest, instead of trying to go through the rest of these questions and open up more topics, let's see if there's anything that we can discuss with the group that's here online. By all means, feel free to drop off whenever you want. I'm happy to stay on for another 10, 15 minutes if there's specific items we want to discuss with this group. And I'm now looking at the comments and seeing if anyone wants to jump in and chat about something. So Christopher asks, wouldn't it be correct to think of Bitcoin as being deflationary once it hits the 21 million cap, but mildly inflationary until it gets there? Yes, technically I think it's inflationary, clearly, but because there's a fixed endpoint, people think over a longer period of time is a reducing amount of inflationary with a fixed total, so people assume ultimately it's deflationary, so the future deflationary expectations get built in to the current inflationary growth. That's a very subtle point, a very good point. And I think the key there is that there's a hard cap at the end. If Bitcoin just said, hey, we're going to add 20% to the coin number per year forever, I don't think it would have bootstrapped as effectively. The Kenton asks, when we earn income in Bitcoins for services, should we be concerned about paying tax on it? I don't know where you live, Kenton, so I'm going to caveat my question that I'm not a tax accountant, I'm not a tax lawyer. How your jurisdiction treats Bitcoin is something you should check, but certainly in the United States, and I suspect in most jurisdictions, you can assume the following is either already the case or will become the case. If a transaction would have been taxable if done in US dollars, the government either is going to take the position like the Internal Revenue Service already has, that if it is done in Bitcoin, it will also be taxable. And if your government hasn't taken that position yet, I will be quite surprised if it ultimately doesn't get there. If I am a national government or I'm a taxation authority, I'm not likely to think to myself that it's a wonderful idea to let people avoid taxes just by asking their income to be paid in Bitcoin. If you had asked for your income to be paid in euros or in dollars or in Ferraris or in boxes of ramen, it's still income in the United States. You still have to account for it. The same thing is true on Bitcoin in the United States. Yeah, Alexa again is talking about the limited supply aspect. I think it's a necessary condition for a private currency to take off. Let me put it that way. How important is it beyond that? I don't know. But it's a necessary condition for it to take off. Because for it to take off, you need people. The network security is provided by the miners. How much network security is provided by the miners is determined by the value of the Bitcoins that they receive, the block rewards. For them, for those coins of value, people have to want to buy Bitcoins. For people to have to buy Bitcoins, they have to have some belief that they'll be more valuable in the future. And so this cap and potential deflationary aspect or potential price appreciation, I think, is a necessary condition to kick off the cycle the way cryptocurrencies are currently designed. Once the cycle has kicked off into some certain level, I have less clear opinion of where that level needs to be. Is it sufficient at $600? Should it be $60? Should it be $60,000? I have no idea. I think that's a much more complicated question. But I think it needs to accrue some initial value for the whole system to prime the pump and start working. And so there's a pretty interesting amount of psychology built into how Bitcoin was designed that allowed it to get off the ground in a way that a lot of private currencies did not manage to get off the ground. Yeah, I don't make any predictions. I see a question about more valuable in the future, the same value in the future. I have a general policy that I don't make Bitcoin price predictions any more than I don't make price predictions about any other currency. I will tell you this, anyone who does make these predictions is always vulnerable to the following question, which is if they're so certain they know the direction of any particular currency or asset, why are they sitting around bothering telling you, as opposed to getting infinitely epically rich by just trading on the direction of the currency? So I think Bitcoin is a very speculative instrument as a financial investment is concerned. There's obviously lots of people who think it might go up in value. There's lots of people who think it's going to go down in value. I think it's safe to say it's a high risk investment. And so even though I don't speculate on the price, probably shouldn't invest your life savings in Bitcoin. If you're interested in the topic and like the topic and put a small amount of your money relative to net worth in Bitcoin just because it's fun and interesting, I think that's something that's not unusual and not scary, but in the same way that you would do any other high risk investment. If you were investing in a early stage startup or in a commodity of some type, you've got to be comfortable with tremendous swings and volatility. You can't take the money you otherwise had in a bank account or in a treasury bond and say, great, this is now getting allocated to Bitcoin. Because that's, I think, a pretty stressful way to live. Oh yeah, no, I don't know if it needs to have more value in the future. I don't know if it needs to have less value. I don't know if it needs to have the same value. It's just not clear. That's my point. I suspect the driver, by the way, of if it has value or not, is none of these investment topics, but whether or not people use it. So let's say there was a bunch of wonderful applications for Bitcoin and lots of people wanted to use Bitcoin for these applications. Then there's a built-in audience of people needing to buy Bitcoin to use these applications. And that's going to support the price much more than any speculative demand on whether or not the supply is limited or not limited. Simply limiting the supply of something will not create value. If I said, I am declaring these 3 pieces of paper to be Polemitis coins, and there's only 3 of them, so they're obviously going to be much more valuable than Bitcoin because there's only 3 of them. That wouldn't, I think, particularly accrue any value to them. I see George is doing some moderating in the comment section. He's right, we're getting into some topics that are a little bit off topic. So I think what we might do, I think it's a sensible time to wrap up this session. Strictly speaking, this was about money. And again, I think a lot of the questions are skipping into other areas where we'll have whole sessions addressing them. So instead of trying to squeeze these in the last minutes as people are falling off, it might be more sensible to just wait until we have those sessions and address them then. So everyone, I want to wrap this up now. I would like to very much welcome you to this course. I would like to thank you for joining us in this course. I look forward to seeing you guys in a few weeks again after you go through the technical sessions with Andreas Antonopoulos. I hope all of you are still here in 6 or 7 sessions so we can continue this discussion. I have to say, I think this was the most active discussion I've ever seen on a live session, so I'm thrilled to see that. And as I mentioned, if there's anything you need, if there are any questions you have, if there's anything you'd like to address, feel free to reach me, feel free to reach George, and we will do our best to answer those questions. Thank you very much from me. For those of you in our time zones, have a great night and a great Friday night. For those of you starting your day, have a great day. And to everyone, have a wonderful weekend. Thank you very much.